Good morning, everyone. Welcome to Capstone Coffee Conversation. Today is December 12th, 2023. Happy holidays to everybody joining us in this cold December morning. I am Brian Felshaw. I'm joined here by Ryan Skogstad up in the Silverdale office. And today we're going to be talking a little bit about annuities. We've been focusing the last couple months on stocks and bonds and the economy and interest rates. And today we're going to kind of go outside of that a little bit under the financial planning umbrella and talk a little bit about what annuities are, the different types, and how they apply. Mostly also because we've been getting a lot of client questions about them lately. And we just want to make sure that everybody knows what they are and how they work. So we're going to do a little interview here, Ryan. We've got some questions for you. So why don't we just start at the top, 30,000-foot view. Tell us what is an annuity? Help us understand that.
Yeah, an annuity inherently is an insurance product type of investment. So it's a packaged investment structure, kind of manufactured, you could say, developed in a lab, but it's an insurance product of a packaged type of investment. The idea of an annuity is to transfer the risk from the investor to the insurance company. So instead of the investor taking the risk of investment volatility, the insurance company takes the risk, and the investor, the person or the individual, has some guarantees involved with this insurance product investment.
And they can be pretty complicated, right? So, one thing to note that I failed to mention at the beginning is if you have questions in the chat, that always makes it fun. Please put those in. We'll make sure we get to them at the end and can talk about them as well. Yeah. So if they are a little different from investments, then how do they differ from a traditional investment like a stock or a bond versus what an annuity is?
Yeah, and we're going to kind of scratch the surface here today on some of these things. They are very difficult to understand. So each of these are going to be very general kind of comparisons, and some of them are a little bit more intricate, but we'll try to hit on the generalities here. So first and foremost, the difference is, at least, I guess before I say the difference is that at least an annuity it's an investment. So that is a good thing in general, but how it differs from a traditional investment, the transfer of risk from the individual to the insurance company has a fee. So typically the annuity are more fee laden contracts, and so your average annual fee is much higher than a traditional investment. Annuities come with liquidity issues. So in a traditional investment, you usually have a lot of flexibility. You can move, you can change, you can take money out, you can change the investment. An annuity is very restrictive, and a lot of times you are locking your money up for 7, even 10 years when you choose to purchase an annuity, and you get very limited choices or very limited liquidity when you do that. Annuities are taxed differently than a traditional investment also. So typically a traditional investment, you invest in something, maybe it grows, you have some tax efficiency as you are paying maybe capital gains rates on the growth of your investment. With an annuity, when you put your money into an annuity, every dollar gained is taxed as ordinary income. So taxed at the individual highest tax bracket possible. So you don't get capital gain treatment, you don't get tax efficiency. And so the tax structure of an annuity is very restrictive. And then finally, also how annuities are passed down to heirs. If somebody passes away owning an annuity, is also not very tax efficient. Typically, if I buy an investment, I pass that investment down to my heirs, they receive a step up in basis, meaning no tax due on any gain that I've made in that investment over my lifetime. An annuity is completely different. The heirs are taxed at their ordinary income rate on all the gain that's been made over the original purchaser's lifetime. So liquidity is very different. Tax efficiency while you own that annuity is very different than a traditional investment. And then finally, how that annuity is passed on to heirs is also not as tax friendly as a traditional investment.
Yeah. So, but there are different kinds, right? I've heard that there's different types. So kind of break that down. What are the different types and categories?
Okay. Yeah. So we'll go through just a few different types. Each of the annuities have a lot of different riders and tweaks that you can make as well. But in general, we'll talk about 3 different types of annuities. First, the easiest annuity to understand is a fixed rate annuity. We'll talk about fixed indexed annuities, probably the most popular or that we hear about today. And then finally, we'll talk about variable annuities and each of the structures of each of those. Fixed annuity, again, the easiest one to understand. It's almost, think of like buying just a very long-term CD. You put your money into an annuity, you get a fixed guaranteed rate of return, like a CD. But typically this is much longer than a CD term, right? So an annuity isn't typically 1 year. Again, it's usually that 7 or 10 or at least 5-year term CDs. And so again, you put it into an annuity. You don't have to pay tax each year, but if you ever start to withdraw the annuity, then you pay tax at ordinary income. So fixed, just kind of think of like a CD, but usually a longer term CD. The fixed indexed annuity is one we hear about the most today. And it's the one that I think is also the most misunderstood type of an annuity. Okay? A fixed indexed annuity, again, an insurance product, but people put in an amount into that annuity. It's linked to an index, and you get a few choices on the index you'd like to tie your money toward. And that could be like the S&P 500 or like a small cap index or an international index, but you link your money to an index. The pitch of this fixed indexed annuity is that your account cannot go down in any one given year. So you put in X amount of dollars, even if that index goes down, you still are level at the end of the year. On the upside, you have a cap rate. So if the cap rate might be, call it 10 or 12%. So if the index goes up 14, you might be capped off at 10. Okay, if the index goes up 20, you would still be capped off at 10. And then finally, the last component of this annuity is what's called a participation rate. And you're able to participate with the index up to a certain ratio. So in other words, we might hear something like a participation rate of 80% with a cap of 10. And what that means is if the index goes up 10, your investment has a participation rate of 80%, you would get 8. So index goes up 10, you would get 8. But if the cap is 10, if the index goes up any higher than 10, you would be capped at that 10. And why this sounds so appealing to people is because I hear this all the time. Well, I don't mind if my money doesn't make 20%. I just don't want it to see it go down ever, right? So I think, well, 12 is a high cap or 10% is a high cap. I don't need to make more than that. I just don't want to see it go down, okay? But what happens in these types of annuities, when you take out the down and you kind of put the floor at 0, but you put the cap at 10 or 12 and a participation rate, you basically have locked yourself into about a 4% return over time. Because even though the stock market seems very volatile and it goes down some and it goes up some and, oh gosh, what's going to happen? 1 out of every 3 years, 1 out of every 3 since 1926, the stock market goes up by more than 20%. And so if you say, well, I don't need more than 12, and you take out all those really good years of very high returns and you miss those because you're capped off, then putting a floor at 0 actually didn't really even help you. Okay. So kind of, if you can take some of the bad times, take some of the good times, your return can be much better than the fixed index annuity typically has about, on average, a 4% return over time.
Yeah, and the annuity companies know that, right? They know those statistics about the long-term run of stocks, right? They know that a third of the time they're going to be over that cap. So I can see why that's very seductive, if you will, of hey, I can't lose, but really the math, may not be in your favor. So I think there's another kind, right? Variable annuities.
The last type is a variable annuity. You get somewhat like a 401k menu of investments where you have 20 to 30 mutual funds that you can choose from, ranging in all different kind of risk spectrums. Your money's invested in those funds at whatever allocation you choose. So then you get kind of the variability of the traditional investment style. However, you pay a fee. Again, this is an insurance risk transfer game. You pay a fee per year, call it 1 to 1.25%, to ensure that if your account goes to 0, you can continue to take out income from your annuity for the rest of your life. So even if the stock market goes away and you've invested in this annuity and you're in this variable account and it goes all the way to zero, you're guaranteed that you will still have income for the rest of your life without going away. And you pay for that guarantee to the tune of about 1 to 1.25% in most variable annuities.
Yeah. Okay, that makes sense. So with those different types and knowing fees might be a little bit higher, liquidity is more difficult, and the tax efficiency isn't there, why would someone want an annuity?
Yeah. I think first off, annuities are sold, and they're sold very well. Okay. The people that sell them typically get paid fairly well for the amount of work that is done to sell an annuity. They're very difficult to understand. So again, a lot of times people buy an annuity and 5, 6, 8 years later, they are trying to get out of those annuities. It sounds too good to be true. I don't ever lose. Yes, I might have a cap, or I'm paying a little bit of a fee for an investment. Now I'm guaranteed I won't ever run out of money. I think that the reason somebody should buy an annuity is if you feel the stock market is going away. If the stock market is going away, then you do not want the risk of holding an investment that's going to go away. Let's put that risk on the insurance company. But if the stock market is still here over the course of your lifetime, the average return in type of average investment market is much better than having to pay for that transfer of risk to the insurance company. So I think that's a lot of times people get really fearful when they see a really tough year in the market and they think, what should I be doing differently? I have to change my strategy. And sometimes, you hear the term, don't just do something, sit there, right? And sometimes just sitting in your seat, even though things are tough, instead of buying into something that then you regret a few years later, because you know what, actually the world's still going round and round and the stock market's still here. But that's, the typical person buys an annuity because they get scared and they want to take that risk off of their table and put it to the insurance company.
That makes sense. And again, I keep saying this point, the insurance companies know that. They know about the long run return of stock. So that's why they're willing to do that, right? Mm-hmm. So compare a little bit more about kind of just investing traditionally, I guess I'll say, versus taking that risk off your shoulders and saying, insurance company, here's the money, you take the risk. Kind of compare those high level.
Yeah. So to summarize, I guess, all of these, an annuity definitely is not my first choice of best way to utilize or invest your money. That's probably coming through. I think if any time that you agree to lock up your money for 7, 10 years and can't look at it and can't make a change, your traditional investment is going to do very well over that time. And you don't need to pay a fee to ensure a long-term 10-year return. And so I think that's the reason that those insurance companies can make those guarantees is your money is locked up without a large penalty, unless you take a large penalty to get back at it over the course of 10 years. And so that's why those guarantees exist, because they know over full market cycles that investment returns get pretty darn close to their averages. In the short term, stock market, bond market, very unpredictable. It's a coin toss on certain years, right? This year's been much better than I would have anticipated. So in the short run, very unpredictable. But you give investment returns 10 years, they become very predictable over time. And so that's where I would say, your traditional investment, keep your flexibility, keep your fees to a minimum. Don't pay more than you have to for an insurance transfer of risk. Keep your tax efficiency, keep your beneficial pass on to heirs as maximized as possible. And because anytime you're locking that up for that long anyway, then you get pretty close to an average rate of return with a traditional investment as well.
Yeah, and one thing to note as we talk about this is we have the ability to do annuities here at Capstone. If we think that's the right tool in the tool belt for a client, we can do them, we can implement them, and we have over the course of our careers. It's just that most circumstances probably don't warrant it, in our opinion. It depends on your situation, right? But something to think about though is annuities do tend to have a high commission for the salesperson. And so if that is something that you're interested in, I would advise looking for an advisor, and this is us too, someone who's not commissioned on that annuity. Rather, it's a fiduciary, non-biased advisor who has the management fee, right? That's an ongoing thing. So it's not a financial incentive to get you into an annuity. And that's something to think about, especially we have a lot of clients who like to snowbird from Washington, and they like to go down to Arizona or Southern Utah or anywhere where it's warmer and go be there for the winter. And if I'm marketing annuities, where am I going to go? I'm going to go where all those people are, all those annuities are. So I've had lots of clients that come back and say, hey, I heard about this seminar that somebody's doing about this thing that can't lose. And I always talk about that's because you're down in Arizona. There's lots of people putting annuities out there down there. So it's something to think about. I'll also mention, Ryan, the clients that I know that have had annuities, it behaviorally, it kind of becomes a challenge as they get older, because there's not a person traditionally on the other side of that annuity. It's just a one-time sale, and now you have a 1-800 number you call to get information, and that can be a challenge as they, as clients age, and already difficult to understand product gets even harder to understand the older we age. And so I think it's something to really think hard about before you take a look at those, basically.
Yeah. I went through 10 years of my first 10 years in this industry having a hard time understanding annuities. Yeah. And so it does take time, and your average client does not know what they own.
Yeah. I will say, I always make the joke with clients when it comes to also you see lots of commercials for annuities, and so you have to think about where does that marketing budget come from? Somewhere along the lines, those fees pay for Brad Paisley and Peyton Manning up on those commercials, making everybody know about annuities. So I think that about wraps it up. I think we'll open it up for questions. Moesha, do we have any questions from anybody in the chat?
What do I do if I already have an annuity?
Good question.
Yeah, if you have an annuity, again, they have some liquidity restrictions typically. So if you have one already, they do give one little caveat, and with that liquidity is most of the time you can take out 10% of your account per year for free. Okay, so 10% of your account per year for free without a surrender charge. So if somebody has an annuity, that's a strategy that we will take on, is we'll say, well, let's slowly get out of here without necessarily paying that surrender fee to take it all out, because that can be pretty expensive, but you're slowly limiting the amount in that annuity over time, right? And the other thing is, there are ways that you can, after the surrender fee, you can 1035 or 1031 exchange into different types that maybe are less fee laden contracts. So just reviewing your current policy, we're happy to do that, whether we can either slowly do it over time or look for a better structure if it has passed the surrender charge.
There's also certain type of annuities called qualified annuities, and they're more like, think of like a 401k. That's a qualified account, a tax deferred account. And once you're past those surrender charges, you might have the option to do a rollover into an IRA. You might mention that earlier, but yeah. So there are some options depending on what phase you're in. What else? Anything else? Okay. Well, thank you all for joining. Please contact your advisor if there's any other questions and follow-up discussion that's needed. We love having you here. Thank you for joining us, and we'll see you in the new year.